Hello, and welcome to this webcast on critical audit matters, what you need to know about the new auditor's communication requirement. I'm Cindy Fernelli, the Executive Director of the Center for Audit Quality, and I'm pleased to moderate our discussion today. Today's panel will discuss the new auditor's reporting model, and in particular, critical audit matters, or CAMs. The identification and communication of CAMs will be a significant change to the information communicated by auditors in the auditor's report, so I'm pleased to have a panel of experts to walk us through what it means for those in the financial reporting ecosystem. Slide 3 sets out our 4 goals for this webcast. First, we'll discuss the PCAOB's requirements for the auditor to determine and communicate CAMs. Then we'll drill down into how investors may use CAMs. After that, we'll take a look at the preparation that is underway to support implementation of CAMs. And finally, we'll cover some frequently asked questions about CAMs. And we have a great panel of experts to help us meet those objectives. We'll go in alphabetical order, so I'm going to start with you, Wes. First, we have Wes Bricker, who is the Chief Accountant for the U.S. Securities and Exchange Commission. In this role, Wes serves as the Principal Advisor to the SEC on accounting and auditing matters. He consults with registrants, auditors, and other industry representatives, and is responsible for the oversight of the FASB and the PCAOB, among the other duties of the Chief Accountant. So thanks so much for joining us, Wes.
Thank you.
Also with us today is Todd Castagna. Todd is an accounting and tax policy analyst in Morgan Stanley's research division. In that capacity, he provides accounting, tax, valuation, and financial modeling consultation services to analysts and investors. He also publishes research on accounting, tax, and valuation topics. Additionally, Todd serves on the FASB's Investor Advisory Committee and co-chairs the Corporate Reporting Users Forum. Todd, we're very glad to have you here with us today. Our third panelist is David Kane. David leads the Americas Professional Practice Group at EY, where he leads EY's national office, including its accounting, auditing, and SEC reporting groups. In addition, he oversees the quality and risk management activities of the firm's assurance practice. And if all of that weren't enough, David chairs both the Advisory Council and the Professional Practice Executive Committee at the CAQ. So David, welcome.
Thank you very much, Cindy. Great to be here.
Our fourth panelist is Leslie Seidman. Leslie is an independent corporate director with over 30 years of experience in the accounting profession, including at the FASB. Leslie serves as a member of the Board of Directors and chair of the Audit Committee of Moody's Corporation and the Financial Industry Regulatory Authority, or FINRA. She is also a member of the Board of Directors of General Electric Company, where she serves on the Audit and Finance and Capital Allocation Committees. Leslie, thanks for joining us.
Thank you, Cindy.
And last but by no means least is Megan Seedsman. Megan is the PCAOB's Chief Auditor and Director of Professional Standards. In this role, Megan leads the PCAOB's efforts to set and interpret standards for the audits of domestic and foreign public companies, the securities of which trade in the United States, as well as the audits of broker-dealers that are registered with the SEC. Megan plays a key role in communicating with investors, auditors, preparers, and audit committees with respect to matters on the PCAOB's research and standard setting agendas and the implementation of current standards, including CAMs. We're very glad to have you on our panel, Megan.
Thank you, Cindy. Happy to be here.
So now we're going to move on to slide 5, and we're going to start talking about the requirements of the new standard. And I'm going to turn to you first, Megan, to walk us through the requirements and the effective dates. But before I do, I will go ahead and give the disclaimer that both you and Wes need to have with respect to letting our audience know that the views that you're going to express with us today are your personal views and not necessarily those of the PCAOB, the SEC, or the staff. So consider yourself disclaimed.
Thank you, Cindy.
So Megan, talk to us about the requirements of the new CAMs as well as the effective dates, if you will.
Sure, thanks, Cindy. Happy to do that. So I think you have on the slide the definition of a CAM, and I'll just point out 3 important pieces of that definition. So CAMs start from matters that were communicated or required to be communicated to the Audit Committee. They relate to accounts or disclosures that are material to the financial statements, and they are those that involve especially challenging, subjective, or complex auditor judgment. CAMs will be required for most audits under the PCAOB standards, but they're not required for emerging growth companies, investment companies, broker-dealers, and employee benefit plans. And we're right around the corner from seeing the first CAMs, because the effective date is for large accelerated filers, for audits of entities or companies that have year ends ending on or after June 30th, 2019. And then for all other audits, it will be for companies to which the requirements apply, so obviously excluding those ones that I just outlined, for fiscal years ending on or after December 15th, 2020. So in terms of what an auditor needs to say about a CAM, for each matter that's communicated to the world at large in the auditor's report, the auditor has to first identify the CAM, and then describe the principal considerations as to why the auditor determined that a particular matter was challenging, subjective, complex, etc. And then describe how the CAM was addressed in the audit, and then also make reference to the particular account balance or disclosure, or both, to which the CAM pertained. And then there's also some requirements in the standard for dealing with the way in which the CAM was addressed in the standard, and there's actually a number of ways in which the auditor can do this. So the standard doesn't actually prescribe exactly what an auditor needs to do, but it says the auditor can communicate the response or the approach that was most relevant in the circumstances, maybe a brief overview of the procedures that were performed, an indication of the outcome of those procedures, and then any key observation with respect to that. And auditors can choose to do some combination of those four, or one or more of them. So there's a lot of ability to adapt to the circumstances. The standard also notes that the language that could be reviewed as disclaiming or qualifying or restricting or somehow minimizing the auditor's responsibility for the critical audit matters or the auditor's opinion on the financial statements is not appropriate and can't be used. And then also the language that is used to sort of introduce the communication of critical audit matters also makes it clear that the auditor is not providing a piecemeal opinion on these CAMs. So that's important to take the whole lot in context. The standards also provide for the language that an auditor might use if they came to the conclusion that there were no CAMs. So the standard does provide for the ability for no CAMs to be the answer, although the release to the new rule does indicate that in most audits it generally would be expected that there is one or more CAMs. But it will be interesting to see how practice evolves on that point. So that's just a little synopsis of the requirements.
Okay, great. That's a good tee up for us. So Wes, having heard Megan talking about that, can you tell us a little bit about the intended benefits of CAM? So this is something that the PCAOB and the SEC has been talking about for a few years, trying to get it right, heard from a variety of stakeholders. But at the end of the day, what's the key benefit? What do you see that as?
The real design of the reporting information is for investors to have additional information to complement the total mix of information that they have when making capital allocation or voting decisions. And so the additional information in this case is to understand more about the audit directly from the auditor's point of view. That information will join then really the trio of voices, both from the auditor, the audit committee and the audit committee's report, or management in their disclosures. Those three voices together should provide an additional perspective about not only the audit, but also the financial information that is being communicated to investors.
So moving on to slide 7, given the importance of this, I mean, this is a standard that's, I would say, maybe with the exception of AS5, is probably the most significant standard that the PCAOB has put forth. Certainly the biggest change to the auditor's report in decades. I don't know the exact time frame. I've heard decades. I've heard centuries. Yeah, I mean, I've heard a lot of time, but a long time. And so I want to talk to both to you, Wes, and you, Megan, too, briefly about what are the plans from both of your respective points of view to monitor implementation, to help make sure from your perspectives that there is effective implementation of this new standard?
Sure, it's a good introduction into really how we see our responsibilities. And that is that standard setting never really ends with the issuance or approval of a standard. Instead, the issuance or approval of a standard really sets us into the next phase of implementation of that standard. And so from the implementation of CAMS in this instance, we have encouraged very strongly a dry run process, where in other words, a way of seeing this be put into practice through a very staged and well-planned practice session, so that whenever the information is ultimately communicated to investors, we have the best calibration, both of its requirements, but also of practice questions that might arise. And so from that perspective, we've been very pleased to encourage dry runs. We also think the dry run process has been very effective, both in providing insights about how the standard is designed and its intended purposes, as well as correcting perhaps a variety of understandings and impressions about the standard. So that process is working. The process, as Megan identified, really starts with the largest of public companies with large accelerated filers, and then we'll have a chance to take stock of how the communications within the auditor's report is working before those requirements within the standard are applied to all other public companies.
And so that's a question that we have from one of our audience members. This does only apply to public companies and not to private companies, nor to mutual funds or broker-dealers, correct?
That's right.
Okay. So Megan, from your perspective, and I'm giving you an opportunity to tease a little bit some of the work that the PCAOB is going to do.
Yeah, sure.
Implementation.
So sort of layering on top of Wes's comments, the PCAOB as a board is very committed to supporting the effective implementation of this new requirement, because as you pointed out, really is, well, I think it's actually 70 plus years, the most dramatic change to the auditor's report. And I think that there's a lot of interest and kind of pent up desire, I think, to see some of this reporting. So what the PCAOB has done is they've put together an interdivisional working group. So it actually is not just the standards group, it's got members, representation from the other divisions at the PCAOB to really work together to support this implementation. So the primary objective of that group is to monitor some of the activities that Wes was talking about in terms of the dry runs that the firms are conducting, to be looking at the firms' methodologies as they are evolving. And this is not inspecting pre-finalization, it's more just engaging so that we can learn exactly how the requirements are being interpreted and understood, and how they're being built into the methodologies that will be used to conduct the audits in a consistent way. And then from our perspective, we're looking to try to really be poised to communicate not only to auditors, but also to investors and audit committee members and preparers about what's going on. So clearly the PCAOB's primary responsibility is to provide guidance, or at least in this regard, to provide the guidance to the auditors, and as Wes talked about, to kind of underscore what's going well, maybe point out some things that could be thought about as things evolve, and maybe just provide a little bit of color around the requirements that sit within the rules. But then also to be providing information, and this is one of the commitments of the new board, is to be very transparent and open in terms of communications with stakeholders and be very engaging. So, we're using a variety of different vehicles, and we'll talk a little bit in a little while about some of the guidance that the PCAOB has just produced, and we're going to continue to monitor the need for more guidance. But there's also other opportunities for our board members on the road through speeches and what have you. And then, we'll be continuing to monitor as things happen, and communicating as we go.
Excellent. So Todd, we've just heard from the regulatory side of the table that investors are a key audience for the CAMS communications. And so as someone who uses this information as well as advises investors, tell us a little bit from your perspective how you think an investor could use this information and how it can help an investor maybe analyze the audit and even the company.
Sure, and I think to Wes's point, what I see as investors, this is bringing a key constituent into the communication process, right? The auditor has such an integral role in the disclosure and the information that some investors maybe have a quiet, passive role now. They're now in an active place. And so I think that brings three benefits. One is just transparency. Most investors aren't auditors, they're not accountants, right? So there's been a knowledge gap of what an audit really is. And so, we're kind of opening up the black box, so to speak. So I think that will certainly help investors, again, understand what an audit is and the objectives of an audit. And then really, what keeps an auditor up at night. And I think that is important for investors when they're trying to understand the information being disclosed in the accounting for a particular entity. And the third thing I will highlight, I think this will actually holistically improve the accounting and the standard setting process. Again, a lot of times we'll hear that certain items are hard to audit, but we've never really seen that kind of in practice, and this will bring that to the forefront. And I think as a former standard setter, I'm really interested to see how this added communication helps us make better accounting rules and disclosure rules going forward.
So you mentioned, or you alluded to the expectations gap when you first started talking to us. Are you at all worried, or what do you think the risks are that an investor might not understand the information that they're getting, might misuse the information? Talk to us a little bit about, from your perspective, what you think about that.
Certainly, I think my biggest concern, and we know this will occur, is there will be constituents that will conflate this to some notion of aggressive accounting, whether rightly or wrongly. And I think communication, right? We need to get in front of investors. Stakeholders need to be all coordinated in the loop, particularly with investor relations, to explain what this information is and what this information isn't. Listen, I think we know the day will come when there will be a large company that has a material misstatement, and the microscope will be under these CAMs, and that will have consequences for the marketplace and for all the members here at this table and companies, and how we process that and move forward. So that that's something that should be a concern of everyone. I will say, though, stepping back, I do think as a past auditor and current investor analyst, that if you weigh the costs and benefits, I do think the benefits of what the PCAOB did in a very pragmatic fashion outweighs some of these costs.
I'd like to just weigh in on one of the other areas where there might be a potential expectation gap, and that goes to one of the things you said about what is a CAM and what isn't a CAM. I was looking for some information about what investors are saying about the CAMs at this point in time, and I actually found a survey that the CFA Institute had done on segment reporting in general. And they asked their survey participants whether they would expect segments to be a CAM. So I thought, well, that's interesting. I haven't seen segments show up on anybody's list of what is likely to be a CAM. So I think there's really room for some education here ahead of time about what kinds of items are likely to be CAMs and why, to try and head off any expectation gaps or disappointment in what ends up being reported in this particular fashion.
No, I think that's right, and we'll talk a little bit when we go through the dry runs, kind of the lessons learned and frequently asked questions, and that is a big one. And we've got some questions from our audience already about the expectations, so we'll get to those in just a minute. So I'm going to turn to you now, Leslie, though, from an audit committee perspective. What do you think audit committees should be thinking about, and how should they be preparing investors or others and themselves for the use of CAMs?
Well, it's already been said, but I think from the audit committee's perspective, this adds a new dimension to the reporting of a company and about a company's accounting and disclosures. And so I think audit committees will be focusing on which of our critical accounting estimates or significant accounting policies are likely to meet the definition of CAMs, and then what about those will be useful to investors. So, I think of this a little bit like currently when you go to a radiologist to get an x-ray of your arm that hurts. You get a report that says your arm isn't broken, and for most people that's enough. But for those diligent investors and others who want to know more about it, they're going to get the full report, which shows what the radiologist did to come to the conclusion that your arm isn't broken. And so just like a patient is not a radiologist, having that extra information or detail gives you comfort that a thoughtful professional has gone through the appropriate steps and shared insights about what types of accounting and reporting matters are particularly challenging for this client for this audit. So I think it adds a new dimension of insight to the matters most important to a company.
And a voice that we've not heard before. Really.
Other than pass-fail, if you
right?
will.
So we have a little bit of experience or insight onto this only because outside of the United States, they have been living with key audit matters, which are slightly different than critical audit matters. And we will dive a little deeper into that later. But I'm just curious, Todd, any early lessons that you've heard of from the investor or analyst community on the what we call KCAMs as opposed to CCAMs?
Right, and as a consumer of that information, it is interesting, and it's I think one of the first things we do is get a better sense for maybe where there are audit risk. But I found myself actually, it's a knee-jerk reaction to go back to the footnotes, go back to the disclosure. Let me reread that footnote again about an acquisition or a transaction or valuation. Let me better understand that. How does that compare to a peer company or competitor that has a very similar dynamic? Are there differences in the KCAM disclosure, so to speak? Is one auditor giving you slightly different language than another, and just trying to holistically understand why you may be seeing similarities or differences, which I think is important. Again, for companies, investor relations, understand competitors, understand peer companies, because there's going to be different nuances and similarities, and being able to have that kind of holistic understanding, I think, helps with the education process as well.
So this leads to one of the questions that we have from our viewers, which is, have you seen in the KCAM perspective any fear or trepidation by investors? Has the disclosure of key audit matters caused investors to hesitate that you're aware of?
So I mainly focus in the United States, but where I have been involved outside, it's just this. It's investors taking a second look at a critical accounting policy, trying to tie the two together and have a better understanding. And so I think for the most part, you connect the dots, you have a conversation with investor relations, and it is additive to the whole conversation. I haven't seen any of the concerns that I described before play out, but I do think those are something to be mindful of.
And I'm curious, Megan, you're recently from the IAASB, and Wes, have you heard any concerns or fears by investors on the key audit matters, or anything else that you'd like to weigh in on before we turn to the actual meat of the dry runs and some of those?
I'll defer to Megan first.
Yeah, sure. And I would just say, I think what the PCAOB has heard along the way in its rule making is very consistent with what Todd and Lizzie have both outlined, and in terms of the driver for this really being investor driven and to respond to calls from investors to have that increased level of information that they know is there, because it's what the auditors have been talking to the audit committee about. But having the additional transparency now in the auditor's report would really provide that unique information that is specific to that audit. And I think what the PCAOB has heard from investors is that reporting should provide the kind of insights that Todd was just talking about. So it's really highlighting which aspects of the financial statements are the most kind of complex to audit or most difficult, so I think it's interesting that you can kind of already see that starting to happen in the KCAM world, and then also enabling the kinds of comparisons that you talked about. So it's different companies within the same industry may or may not necessarily have the same kind of CAMs, but you also have the ability to look and see how CAMs might evolve or change one year to the next. So I think it's certainly we're hearing a lot, but I think there's also a lot of what Todd said around CAM's not been bad or negative, or something that's something to be feared. I think that's what we hope is not going to be the outcome. But there's definitely, I think, a lot of need for increased information and for really people to be engaged, so that that investors actually are understanding the information that is being provided.
I would just add 3 quick points. One, I think it's a terrific conversation which reinforces the relevance of auditor communications, as well as the communications within the financial statements and the disclosures, as well as the audit committee report. So relevance, I think, is really at the center of the discussion. Second point, just building on Todd's very good point, that it's an opportunity to take stock of the sensible expectations of the work that auditors do, and this is a way of adding insight into the most complex, subjective, or challenging areas within the scope of the audit. And then finally, I think it's quite appropriate for all of us to be very vigilant as the information is communicated out, and to understand how the standard is working in practice, so that we understand the investor experience and can adjust to reinforce the intended purposes of the standard.
So a quick question from one of our viewers that touches on something you just said, Megan, which was the evolution of the CAM from year to year. I know there's been a lot of thought and discussion, both by the regulators as well as, we'll get you in on the conversation, David, about there being boilerplate, being cookie cutter, that once you see a CAM, it's always going to be that way and it'll never change. And critics will say that we sometimes see that in management's reporting, and so quite curious as to what the expectations are about that and how we might guard against it, even though it hasn't even yet gone into effect.
And clearly, I think there's been a lot of thought about that, and obviously a lot of concern. And as the rule made its way through the rule-making process, a lot of that concern was voiced loud and clearly by commenters along the way. You can never protect 100% against boilerplate, but I think that there is enough in the rule and the related supporting materials to really emphasize the importance of CAMs being company and audit specific. So, that's not to say that you might not see similar kinds of CAMs for companies that are in a similar industry. They have the same kinds of accounts and disclosures generally, so there would be some element of similarity, and some things don't necessarily change all that much from one year to the next. But each year there could be something different internally, or there could be something environmentally, or sort of broader that could impact how that audit is actually going to play out, and what becomes the most challenging or most complex issue in a particular audit. So, I think it's a little early to say, because obviously we don't quite know how this is going to play out. But I think there is a real risk of boilerplate. But I think it then goes maybe back to what Wes was saying about how everyone really needs to be focused, and for investors to be engaged. And I think the more that the investors are seen to value what is being produced, and maybe value differentiation or the more informative piece, because it really should be based on that particular audit and company, hopefully that will then drive good practice and kind of an evolution as we move beyond year one.
So let's move to slide 9, and David, I do want to get you involved in the conversation, because we've referenced the Dryruns. We've talked about the importance of that. Even though we haven't yet gone into the effective date, I know that EY and others have spent a lot of time doing the Dryruns. So can you talk a little bit about the Dryrun process, what you all did at EY, and then we'll get into maybe some of the lessons learned from those Dryruns. But first, what it is, explain that to us.
Yeah, Cindy, and as Megan was describing, this is the most significant change in audit reporting in, I used to say decades, now I know it's 70 years, and obviously a huge undertaking for the profession. But there are also significant impacts for everybody else along the entire supply chain. So here we're thinking about preparers, management, audit committees, investors, as well as regulators. So using live fact patterns enabled us to proactively identify and address issues, making sure that we were trying to do everything we could collectively across the supply chain to get it right the first time. So I'd say in terms of the objectives, I put them into 3 buckets. First was around education and preparation. Better level setting, defining what a CAM is and what it's not, and preparation not just for us, but also thinking about for the audit committees and thinking about management, make sure that they are all very well prepared for this. Second piece was around drafting, discussing, and documenting. So drafting the CAMs using live fact patterns and working through issues more in real time really did help us identify issues much more timely on this. We discussed them with the audit committee, which I'll talk about, and that really enabled a deeper conversation about audit quality. And also documenting. So I think folks are very much focused on documenting the CAMs and how we describe them, but there's also other responsibilities that we have with respect to the documentation in terms of describing why a matter, for example, was not a CAM that might have been communicated or required to be communicated to the audit committee. And then the third bucket I would say is really around enablement and quality control. This is a very significant undertaking. We wanted to make sure that we were enabling our teams appropriately. So what did that mean? That meant training, writing guides and examples. And at the same time, we're also thinking about quality control. All the issuers are required to have an engagement quality reviewer, so it's training him or her in terms of what the requirements were, but also particularly as we were getting off the ground, thinking about whether an additional layer of review, a little bit more centralized, would also afford us the opportunity to make sure that we're meeting the important requirements in the standard.
So you mentioned the ecosystem, not the word you used, but the word I'm going to use, but that while it's the auditor's report, and this is the auditor's critical audit matters, you mentioned that it's going to be important that management be involved, that audit committees be involved. How has that worked in the dry runs? And we've got a question about this, is what role should the reporting teams expected to play in the development of the auditor's report?
Yeah, it's a really great question over here. I would say in terms of the dry runs, both management and the audit committee played a very significant role in terms of the execution of these dry runs. When we think about the comment letter process and the exposure period, it went on for a period of years, and I think the definition continued to evolve. This was an opportunity for us to take a step back and level set on exactly what CAMs are, but also what CAMs are not, and the types of matters that would be CAMs. As well as it also gave us the opportunity in describing the matters and how they were addressed in the audit, to give the opportunity to preparers to go back and take a look at their own financial reporting and making sure that it appropriately aligned where it needed to, both inside the financial statements as well as outside, particularly when I start thinking about critical audit matters. Third piece of this was also enabling the preparers to understand the impacts to the financial reporting process itself, how that was actually going to be undertaken during the year in terms of communications, year-end type of reporting, but also enable them to start thinking through education of their own internal constituents over here, which could mean, for example, investor relations and making sure that they were prepared to answer questions that may come up during this process. So the way it unfolded during the year, at least for us, was we had a preliminary discussion around the identification of CAMs and again what they are and what they're not. We then updated that and then drafted the CAMs themselves, which we reviewed with the audit committee generally during the third quarter. We updated that through year end and presented to management a mock-up report so they could see exactly what it would look like, assuming that we had been through the adoption over here. And I think it really did achieve the benefit of better enabling management and the audit committee. Otherwise, it's too abstract. You need to be able to work through these issues, discuss them, see something tangible around this to get that visibility and confidence around the process. And I think management and the audit committees were generally very receptive to this, and they found this overall a very positive experience. I will say as well, just from terms of the dry runs, which we're going to be talking about a lot today, I don't think the benefits of those can be overstated. If we had tried as a profession working through the entire supply chain to go through those issues during calendar 19, that would have been a real challenge in terms of all of the issues that needed to be identified, discussed, making sure that we all had the confidence heading in that we're all doing the right things on this.
Well, I have to say, from where I sit, I really want to commend EY and the other accounting firms for doing that. It was a lot of work for you all to do. your normal audit process and then to do the dry runs. But I think to your point, and we've, I don't think it's any secret, we have shared some of those findings and lessons learned with the PCAOB, which is nice to be able to do that. And so I think it benefits everybody that we've gone through that. So let me flip it over to you now, going to slide 10, Leslie. You heard it from David's perspective. From your perspective as an audit committee member, what do you see about the dry runs? Any information that you got? Just overall general thoughts on the dry runs, having gone through a couple, I'm guessing.
Sure. I first want to start by saying I think that companies are in different places in terms of where they are in the dry run process. I think, step number one is education, just to make sure everybody's aware of the new requirements for auditors and the implications for the company and its own potential reporting practices. Because of the required communications that are already in place between auditors and audit committees, I think we have a handle on the universe of issues that we could be talking about, unless, of course, some new transaction or situation arises during the year. So it's really a matter of trying to identify how we're going to narrow down the critical accounting estimates and the significant accounting policies into those matters that would represent the critical audit matters for the company. And so the dry runs have been helpful to have a preliminary discussion about which of the critical accounting matters and significant accounting policies are likely to be the CAMs for this particular company and why. And then to see examples, whether they relate to your own specific audit or just general examples that we've seen drawn from the European KCAMs or a more generic form of it, to get a sense of the type of information about how the auditor considered those accounting or disclosure issues in the audit. That to me is just the beginning. There's a lot more to do in terms of these dry runs, because we're going to be approaching this, and when I say we, I don't mean any company in particular, but generally public companies will be treating this like any other change in accounting. And I would envision that most companies will put together a team of people who have a stake in effective communication about financial reporting. And throughout this process, we'll be discussing the implications for, and some of these have already been mentioned, but investor relations, the tax department, to the extent that you might have a CAM related to taxes. Who else? The financial planning and analysis group, of course, the general counsel's office, et cetera. And more specifically, I would say as we get closer, the disclosure committee, so that everybody's involved about what the auditors are planning to identify as CAMs and what they're planning to say about it, and then circle back to whether there are any implications for our own reporting, whether it's in MD&A or the footnotes themselves.
So let's switch over to slide 11, because I do want to talk about, we'll spend a good chunk of time here talking about some of the early lessons learned from the dry runs. And I will note too that in December, the CAQ put out a report or a resource that talks through some of the early lessons learned from the CAM dry run. So if you're interested, I would point you to the CAQ's website to look for that resource. It's free of charge and publicly available. But we'll spend some time here, a good 15-20 minutes, kind of doing a deeper dive into some of the lessons learned. And we have a lot of questions from our viewers about this too, which we'll cover, and then whatever we don't cover, I'll come back to those. So those of you that are watching, please be patient. We will try to get to all of your questions. So I guess there are two buckets, right? We've talked about there's the identification or the determining of what's a CAM and drafting the CAM communications, and then there's the identification and the communication. So let's start with determining which matters are CAMs. If you could drill down a little bit deeper into some of those lessons learned, maybe some of the pain points during the dry run that you've seen.
Yeah, it sounds relatively straightforward in terms of trying to identify CAMs, but I think it was a little bit more challenging than some had expected. And why do I say that? When I think about the profession, we're in a trust business, but we're also in a risk business in terms of identifying, assessing, and responding to risks of material misstatement. We've got obviously a very deep understanding about auditing standards and also the financial reporting frameworks. But we also know the companies very well. We've got experience with them in terms of their internal controls, their accounting policies, maybe historically any types of control deficiencies or audit differences. So I think there was an opportunity to put all of that on the table, but in teams trying to reach the judgment about what constituted a CAM really required them to think about that definition. And I think in some cases, maybe teams set a little bit of a higher bar than what was otherwise necessary on that, mostly because of the familiarity. And we are so close to this, and it's what we do for a living. So we use this opportunity to also take a step back and ask folks to really think about that from the investor's point of view and sitting in their shoes. That experience that we have is incredible. We need to think about how to unlock that, though, and to provide the insights and greater transparency around why matters were CAMs, as well as in terms of how we addressed it in terms of the audit. Also recognizing that in terms of expectations gaps and just knowledge, there may be a fairly significant gap just between what we know and what investors know, but they're looking for that additional perspective. So I'd put that into one camp. The other camp I'd put in more is about topical issues that came up and just in terms of how do we think through certain things. So here, what am I talking about? Might be cyber breaches, might be IT implementation. We talked about before risk of boilerplate, but what do you do when you have CAMs that cut across multiple periods? And I think the PCAOB's guidance is very helpful and on point with many of those issues that were raised. I think the other piece, and we talked a little bit about this, was on sectors, and that was an area audit committees and we were very focused on. I think unsurprisingly, when you cut across industries, there was more similarities than differences when it came to the nature of the CAMs. So when you think about the financial services industry or banks, it would not be unsurprising to see the allowance for loan and lease losses on there. I think what we did see, and this is very encouraging and very positive, is that the descriptions of why the matter was a CAM, along with how it was addressed in the audit, did vary pretty significantly and considerably between and among reports. And I suspect as we talk about the evolution, that will only continue to get more granular over time and provide that additional transparency that investors are looking for.
Great. So now let's talk about the communication. So what are some of the lessons learned on the drafting of the communications of the CAM?
Yeah, so once again, it sounds pretty straightforward in terms of drafting some of these, but the devil's always in the details. I'd say one theme is really just around consistency. And I want to pause here because when I say consistency, I am not referring to making these boilerplate or overly generic. To be sure, we are absolutely focused on making sure that those CAMs are directly responsive to the audit, to the individual facts and circumstances, and are really bespoke. But at the same time, we also have an opportunity, when you think about a number of teams that are going to be drafting these, to provide greater consistency in terms of tone, greater consistency in terms of voice, as well as in terms of descriptions. So that's where the enablement came in terms of our development of writing guides and examples to help the teams. I think the other piece that we were really focused on is something that's identified in the PCAOB's guidance as well, is the description of CAMs and why they were CAMs. And why? A little bit on the familiarity side, but also companies got very robust disclosures. So sometimes I think folks may have thought, I don't have a lot more to add with respect to that when you put that total mix of information again together. And that's where the PCAOB's guidance also comes in to say, that's all true, but we really want to hear from the auditor and specifically why you thought the matter was challenging, subjective, or complex. So that was another positive piece. I do think at the same time, what we really wanted to capitalize on in terms of the description was to deepen the conversation about audit quality. So what do I mean by that? In discussing the CAMs and specifically why they were CAMs, the types of risks that manifest themselves and why it was challenging, as well as how we were planning on addressing those as part of the audit, I think gave the audit committee and even management greater transparency into the audit process and how we assess risk. And I think for some audit committees, probably even help them connect the dots a little bit better about the financial reporting framework, particularly if you think about information inside the financials, outside the financials, and tying that to CAMs. So again, I think variety of benefits that we had coming out of this dry run.
So I want to touch on something that you just mentioned. You were talking about the consistency and consistency versus boilerplate or cookie cutter. it's my understanding that national office at EY and the other firms are heavily involved to that very point. Again, not to make sure that all of the language is the same, but make sure that the engagement teams, because this is audit specific, right? It's going to be up to the lead engagement partner to be drafting this communication with the help from others. But can you talk a little bit about the role of national office versus the engagement team?
Yeah, so we put out a fair amount of guidance with respect to writing guides and examples, but each team went in based upon the training, and we really encouraged them to think about it for themselves. This was not to be something that we wanted just to give to some boilerplate types of examples, and purposefully limited the number of examples there in order to provide and promote that type of creativity in going through this and making sure that they're appropriately tailored. But I think one of the things we did see coming through that was that there were some differences in terms of the descriptions. And to the point earlier about consistency, I do think that's important. So let me give you a practical example. Let's say you've got two companies, similar industries, that have got relatively the same risk profile, and in terms of the way we approached it in terms of the audit. Let's say on one report, it was fairly brief on both counts. And let's say on another report, again, same types of risks, same types of procedures, it's much more extensive. You know, an investor, we were thinking in looking at this, might inappropriately perceive that company number 2 is much more risky, might have more challenging, let's just say, accounting policies that we may have had to wrestle through the engagement, and are going to be inappropriately inferring that one company is inherently a little bit more risky with respect to an audit than another company, which in fact is not the case. So again, it's trying to strike that right balance, Cindy, I think, when we think about the National Office Review, to make sure that we've got that tone and voice there. They are appropriately bespoke, but that we do have some degree of consistency in terms of depth of descriptions of those.
So as we're looking at slide 12 and talking about examples of a CAM, one thing I do want to note, and Megan, maybe you can weigh in on this. I know in the adopting release and in some of the literature that the PCAOB has put out, there's that fine line between being communicative but not being too technical, being in plain English. Can you give us a little more of your expectations around that?
Yeah, well, it's interesting listening to David, because I think that the lessons that are coming out of the dry runs I think are very aligned with the things that the board was thinking about as that release and the rule was coming together. So, you know, there is the fine line about being overly prescriptive, which I think would then drive the boilerplate and all that kind of stuff. So, I mean, I think the hope is that the rule strikes that right balance between providing the framework but providing for the ability for it to be adapted to the individual companies and audits. You know, the PCAOB also made the decision to not include an illustrative example. So in one of the prior releases for one of the reproposals, there were some examples. And the decision was made in the final release to not do that. And I think some of it was the concern that it would then basically become the standard, and we wouldn't have anyone deviating from that. So I think I wasn't there at the time, but my understanding is that is that really was the concern and was the reason why the PCAOB then did not choose to provide an illustrative example, because they felt like it could be too anchoring. So I think the desire is that this will evolve and that auditors will find the right framework within the rule that has been adopted.
Well, the PCAOB decided not to put an illustrative CAM or an example of a CAM in the literature, but the CAQ opted to do that. So, David, I'm going to put you on the spot and talk to you a little bit about that. I will reiterate the point that it's meant to be an example for illustrative purposes only. It's not meant to be what you should use or what the disclosure should look like. But do you want to talk a little bit about the example CAM and the PCAOB's, and the CAQ's resource? Yeah,
because I do think, Cindy, just to reinforce, it is a data point. I wouldn't say it's the be-all, end-all, but I think it's something tangible for investors to look forward to. And this is something where the profession came together working as part of the CAQ to draft this. And I think it's instructive in a couple different ways. One is it enables investors to understand how the CAMs are deconstructed in terms of what they can expect to see in terms of why a matter was a CAM, and also how it was addressed in terms of the audit. and gives them something more tangible to read and understand in terms of that, as opposed to abstract. I think the other benefit is, and I would really encourage investors to take a look at that example, you can begin to set some expectations in terms of alignment for the CAM against the company's financial reporting as well, and really see how the two sync up in terms of those risks, as well as what the auditor did in response to those risks.
And I think that process is helpful, that lays out in that CAM example, because again, I think most investors aren't auditors and not accountants, and so seeing those two juxtaposed next to each other is really that complete information.
Yeah, and again, as Megan said earlier, we're only about 3 months away from seeing the first set of CAMs, which I think everyone will probably be very eagerly interested in reading to understand how all this came together.
Well, and I think too, we'll talk a little bit about it later, but I think, if your only example to see is the key audit matters, the K-CAMs under the IAASB, I think C-CAMs are going to look much different than K-CAMs, maybe not, but if that's all you've seen, we felt on balance it was better to include something to help manage everybody's expectations, including auditors' expectations, right?
Exactly.
What exactly are we talking about here?
Exactly.
So,
And I do think, Cindy, as well, we have an opportunity as a profession to continue that education with investors, show them what it looks like, the types of processes that we used internally, and as well give them some additional transparency about the audit. Because I do think after all this time, I don't think we can talk about the audit enough, and really everything that we do, particularly in terms of risk assessment, to give investors comfort about audit quality and everything we're doing to make sure that those numbers have the appropriate integrity.
So I want to have a little bit of a dialogue both with you, David, and you, Leslie, and others weigh in, but about the actual process, the timing of the process. We've gotten a few questions here about, when would the auditor start talking to the audit committee about what might be potential CAMs? Is it during the audit planning stage? Is it throughout the entire audit? When do you share draft CAMs with the audit committee? So just from your experiences, I know you can't answer generically, but I'm just curious from your two perspectives, having gone through the dry run, your sense of that.
Yeah, I'll start just in terms of from our perspective. The appropriate time is during planning, as we're scoping out the audit for the year, to begin those discussions about the CAM. Provides a great opportunity from a risk assessment perspective to make sure that we're conveying our ideas about risk and where that manifests itself, but also get the audit committee's reaction to that. While of course we're going to update it throughout the entire audit, as I was mentioning before, I think coming in during the third quarter as opposed to during year end, where there is so much coming together at once, to really enable a facilitated dialogue and a deeper dialogue about the CAMs and what was mentioned before in terms of audit quality, I think affords us more of an opportunity there. And then use the year-end time frame to really roll that forward and actually deliver the final CAMs, including any types of touch-ups or anything else that was there, but to try to accelerate that really before the year-end time frame, because again, there's just a lot of communications that have to happen, a lot of things that the company they're working through in terms of financial reporting, and we want to make sure that it gets the appropriate transparency and discussion.
Right, and just building on that, I'd say the audit committee is going to want to see how in the audit plan the CAMs are factored in. And so, we'd like to see the plan that the auditors have for communicating with us about the identification of the CAMs, any drafts of preliminary communication about the CAMs, et cetera. And then from the company's standpoint, we would like the opportunity to consider whether there's a need for us to revisit any of the disclosures that we have about those matters in MD&A or elsewhere in our financial reporting. And we won't really know how we want to enhance that until we see a draft of the CAMs. So, just as an aside, there are certain areas of accounting that don't have extensive requirements about disclosures. And so there may be cases where the auditors have always considered it a particularly risky area, but there may not be a GAAP disclosure requirement. You might have something in MD&A, but it might not tie in nicely with the way the auditors are going to be communicating about it. So we'd like an opportunity to have some time to take a fresh look at our own disclosures and make sure that the whole package of information hangs together nicely so that an investor could, connect the dots, if you will.
So a lot of questions from the viewership about what if there are disagreements between management and the auditor? How much voice does the management reporting or the audit committee have in the identification, communication of critical audit matters? Care to take that on?
Well, I'll say in terms of our dry run process, we have not experienced that yet. I think there is, and that's a good sign, because I think a lot of this, if we take a step back, is around education, is around information. I would say in general, I don't think audit committees were surprised by the CAMs that they saw. I mean, these are matters that we have been talking to them regularly in, as part of the audit over here. And I think once they got a better understanding and were able to actually see it in paper, on paper, in terms of what those descriptions will look like, I think it helped narrow the expectations gap a bit. I will say the dry run, I think, gave us an opportunity to take some anxiety out of the system. What I was mentioning before, there was just a lot of concern out there about original information. I think once companies and management and audit committees really saw these, I think that relaxed that a bit more, which was, I think, from our perspective, very positive. Is there a risk that there might be a disagreement in the future? Yes, but I think just through continued communication and making sure that both sides understand each other's perspectives on this, we'll be able to reach a pretty satisfactory resolution.
I think that sounds very reasonable, and I'm not at the moment expecting a lot of disagreements about this, because at the end of the day, the requirements have to do with how the auditor audited what we've all agreed are either critical accounting estimates or significant accounting policies. So, they're the professionals. We've engaged them to do this work, and at the end of the day, I think they have the say about how they, considered these matters in their audit. But like I said, that might require us to be clearer in our own financial reporting about the judgments we made, how we considered alternatives, et cetera.
Which of course is the goal, right, of all of this, is to have better information for investors around the entire process. And this was I think, a key piece of information that was missing, which was the auditor's perspective. You had management's, even you have audit committees disclosure, right, in the proxy and elsewhere, but you really didn't have a lot of insight into the audit. So.
I would just jump in to reinforce the points that Leslie and David have made. Around the importance of planning and communication, education, understanding expectations. I think those are the ways to really mitigate the possibility of a material disagreement. I think it's important for anyone involved in the disclosure-based system that we have to seek to understand others' points of view. And so in that sense, certainly there's the possibility of a material disagreement, and we have systems designed to resolve those situations. But from my vantage point, it's better to know what those areas are so that they can be resolved over the course of preparing the information, so that the end product for investors reflect again, that trio of voices, management's, the audit committees, and the auditor's voice, with as much consistency and clarity as the three can work out.
Todd, do you want to weigh in on any thoughts how you might use all three pieces of the information?
Yeah, no, I think that's right. You're adding a voice, and again, it's corroboration of the information from all the stakeholders, whether that's the audit, the board of directors, the management team, and I think this will really will help investors better understand the information they're digesting. I think to your point, I can see this in the future improving disclosures holistically. Maybe companies will choose to add more in their MD&A about a critical accounting estimate or a decision. I think it'll help accounting standard setting. Again, if we see some sort of themes, or we call it potentially boilerplate, that every single company has a very similar CAM, well, maybe there's a way we can account for that item or disclose that item better, right? So, do
you have any particular areas in mind?
Well, I mean, it's a pension accounting is a big one, right?
Pensions.
I think CECL is going to be an interesting one when that's rolled out, but allowance for loan losses, goodwill impairment. It's interesting when companies will announce a control deficiency or a weakness. A lot of the questions we get is, well, how does the auditor process that? What are they looking at? So again, I think this will add to that voice, and I think at the end of the day, people have more trust in the system, and that's I think a core feature of this standard.
Are you worried at all that investors might view a CAM as a bad thing? I mean, we've all been very careful, I think, to try to telegraph and communicate that CAMs are neutral. They're not inherently good or bad. But I know that there's a little bit of concern that investors might view a CAM as a red flag or a concern or a bad thing.
There's certainly, it will be conflated. First of all, we shouldn't paint all investors with one brush.
True.
We tend to do that, but
do.
that will certainly happen. I can foresee activist style investing. This will be brought up, particularly if you have control issues. I think this elevates that focus, and I do think there will be a knee-jerk reaction for some to conflate it as a potential aggressive accounting. That's why I think the communication is absolutely critical, and how I think the examples of how it's communicated, what was the issue, why was it a CAM, and the process of around resolving that is crucial.
This is making me think about certain areas of accounting are just inherently judgmental. And I'm thinking of pension accounting as a perfect example.
Yeah.
There was a time when pension accounting was simple. It was on a cash basis, right? But then I think we decided that was not good accounting. I wonder if there's a way, or if one of the ways we're going to enhance our disclosure to mitigate the concern that people will view a CAM as bad is unfortunately to maybe regurgitate a little bit what the accounting requirement is that's making it judgmental. In other words, the company isn't taking a swag. The company is trying to comply with a very judgmental accounting standard, the discount rate, the mortality input, et cetera, and these are not absolutes. They're best estimates at a point in time, and they will change in the future. We know that.
And I think this will bring all that to the surface.
Yeah.
And I really do think it'll help kind of move the ball forward. And does the accounting match the economics, or can we improve that? And does it, can we make it easier for preparers, for auditors, for users to absorb and digest this information?
Yeah, I think particularly if you start thinking about the different sources of information that investors are going to have, they're going to have certainly the financial statements, which will give them a very in-depth understanding. I think pairing that with the critical accounting estimates, be able to deconstruct some of these, talk about some what-if type scenarios, how that could be impacted, and then tying that into the audit in terms of how we viewed it, why it was challenging, subjective, or complex. Deconstruct that a little bit more maybe, talk about certain of these assumptions and how we address it in the audit. I think we'll give a more complete picture and be able to enable investors to connect the dots more than what they are able to go do today on their own.
Yeah.
So that's a good segue into slide 13. And Megan, I'm going to ask you, the PCAOB has recently released several publications actually related to the implementation of the new requirements. You gave staff guidance that I think was meant to help auditors as they're going through the process, but also to others as well. So can you talk to us a little bit about the impetus behind those and give us a little more flavor for those? Because I think they're good resources.
Yeah, sure, and I'd be very happy to do that. And obviously, as I mentioned before, the board is really committed to being outward-facing with respect to supporting the implementation of CAM. So this is an attempt to do that, and I think it's an attempt to kind of get ahead of even the effective date and provide some guidance real time to really drive successful first-time implementation to the greatest extent. So, we've been fortunate in that we've been able to hear from lots of different places and groups of people about what their questions are. David mentioned the Dryruns and mentioned some of the interactions and sharing of their experiences with the PCAOB, which was really helpful because it got us to be able to understand some of the questions that people were asking that, maybe are not exactly answered by the exact sentence in the release or the way in which the rule works. And it was interesting. I mean, I think you always get this is when different people read something. I mean, you can think you've written it crystal clear, and how can it possibly be interpreted different ways? And no sooner do you get different people to look at it, and they all come at it with a different perspective. So, as you can imagine, there were a lot of questions that came out. So there wasn't a desire to really try to provide something that was going to be helpful. So I'm probably starting at the bottom, which is the deeper dive document, which is an attempt to really get into some of those Q&As or FAQs, call them what you will, that really gave some observations from a staff perspective. And I should actually note that is a staff document too. It's not a formal board document, but just really the staff's views on the guidance, and is trying to provide a little bit more context to some of those particular matters. But then, we also recognize the importance of communicating with our other stakeholders. So we put together our basics document, which is a high-level overview. It's not really an executive summary. It's more just, it's meant to be at that higher level. It's, probably something that if, someone didn't have any idea of what this was all about, it's not a long read, and it should give investors and preparers and audit committee members who, for some reason, have been living under a rock and don't know anything about what's coming. You could get sort of a quick feel for the new requirements and what they're all about. So I think so that we prepared that with that kind of intent in mind. And then the middle document is really it's a document that summarizes the staff's observations of the review of the firm methodologies. So as the document describes, one of the things that the PCAOB did was to engage with the firms, and we requested the 10 largest U.S. audit firms, which is they will collectively audit the vast majority of large accelerated filers who will be the first out of the door. We looked at those methodologies really from the perspective of just understanding how people were interpreting the requirements and how they were building out those methodologies. It's not an inspection or anything like that. It was just intended to help inform the PCAOB, and then the lessons that we learned from that informed some of the Q&As that we put into the deep dive. So really just big picture, it's in a way to try to provide that level of guidance. Like I said before, we'll continue to monitor the questions. Maybe there'll be another series of deep dives, as we go along. And then, Cindy, one other thing I'm just going to mention is that last week the PCAOB did announce that we're going to do a webcast, which will provide a little bit more context about these documents, give a little bit of a deeper dive into the deeper dive. So that will be an opportunity for for those who are interested to hear a little bit more from us with respect to those documents. Thank you.
And Wes, really quickly, before we get into some of the frequently asked questions, what was the SEC's role in the staff guidance and these webcasts and the other resources?
It's easy to be quick on this. It was to find consistency in message, which we've done. Also to share feedback that we've seen, so that working together with the PCAOB, there's a common view, a common understanding. Because we're really working at this together.
Yeah, Cindy, I probably have to add on to this, but I have to be very careful in my comments, given I'm sandwiched between two regulators. But I will tell you, I think the commitment by the SEC and the PCAOB as key members of the supply chain as well, the ecosystem as you referred to enable us all to get it right the first time has been incredibly impactful. You take a look at, in terms of the PCAOB, getting out these documents now, just in terms of how the firms have been applying it, and in terms of topical areas and questions that the profession has come back with, gives us much more confidence moving ahead that we're reaching the right judgments, which is ultimately going to reduce expectations gaps and is ultimately going to lead to a better quality product that's going to benefit everybody. Mm-hmm. The profession, think about preparers, think about audit committee members, and most importantly in terms of investors. So we look forward to really continuing that dialogue.
Yeah, we all want this to be successful, right? We all have the same common goal, which is to give investors more information about the process so that they can make the best voting or investment decisions. And so it's nice to see us all working toward that common goal. So let's now turn to slide 14 and get into some of the frequently asked questions that I've heard, that all of those sitting around the table have heard. We've got a number of them here from our viewers. So let's go ahead and kind of dive right in. And Wes, I'm going to start with you. Because one of a theme of some of the questions that we've gotten here is, and we've touched on it, but how will CAMs relate to the disclosures made by management? And so I think we should spend a few minutes, all of us, talking about the difference, Leslie, you mentioned this too, between critical accounting estimates, critical accounting policies. Is it a one-to-one? You mentioned, which I think was really important, that as the auditors talk about the critical audit matters, will you go back and review what the company's disclosures are? So can we have a conversation, all of us, about that?
Sure.
Because a lot of the questions that I've heard stem from that. So I'll start with you, Wes, and then we can just spend 5-10 minutes talking about that.
Sure. On the question of whether that arises of whether CAMs should duplicate information that management has otherwise provided. That's certainly not the design of the standard. The design of the standard is that the auditor is providing the auditor's unique perspective regarding a particular aspect of the audit. The standard, of course, does contemplate that the auditor might find themselves to be in a situation where they need to provide additional or original information in order to describe the principal considerations that the auditor considered. We would expect that to be rare, and indeed, in the feedback that we've received through the Dryruns process, our expectation is confirmed. That is that management generally has gone ahead. They've taken a fresh look at their disclosures, such that the information is otherwise contained within the financial statements, and so I do think it's appropriate to recognize that as an issue, but our experience is that it's not duplicative.
Yeah, maybe Cindy, you mentioned critical accounting estimates. Maybe just spend a second on that, because I know there are a number of questions out there saying, is every critical accounting estimate a CAM? I mean, I think the short answer to that is no, but let's unpack that a little bit. I think it's important, first, start with the definitions. And we think about CAM being specifically identified by the PCAOB, think about material accounts or disclosures, but especially challenging, subjective, or complex. In contrast, the critical accounting estimates, which is SEC guidance, is really talking about material estimates, thinking about highly susceptible to change, maybe under different economic conditions, or you might have been able to use reasonably alternative assumptions, and that could have a material impact on the overall estimate or in terms of the financial statements themselves. So while there's a strong correlation, I wouldn't say it's one for one. So let's talk about what a couple examples might be. There might be some companies that have in their critical accounting estimates, let's say stock compensation, and maybe they put historical volatility ratios in there or expected terms. That, while very informative, might not necessarily be a CAM because it may not involve especially challenging, subjective, or complex type matters. Some companies put in as critical accounting estimates their sales returns and allowances policy and historical rates, or maybe allowance for bad debts, not for a financial services company, but I'm saying for a traditional type manufacturing company. Those might be similar type areas that you wouldn't generally expect to see as CAMs, and there could be differences. At the same time, we've got CAMs that are not going to be critical accounting estimates. So one example of that might be is around going concern. I think that area, while it's some expanded disclosure in terms of the footnotes more recently, and we do have different definitions of what that is, so that'll be interesting to see how that begins to manifest itself, won't necessarily line up with that. Or you could just have a company in terms of an accounting policy, let's say, with respect to software costs, and maybe it was a material amount that was to be capitalized, and the type of judgment you have to use in order to figure out whether it was appropriately capitalized or in terms of impairment. Maybe that doesn't make it into a critical accounting estimate. I think the benefit was, though, because there is that strong reservoir and there is some expectation that there might be some similarities, I think it's enabled companies to go back and really challenge what those critical accounting estimates were. I would say when I go back and think about when the guidance first came out from the SEC, I think many companies just took their Note 1 and actually put that in the critical accounting estimates, and certainly those have begun to evolve over time. But I think there's also been a tendency for some companies that once it's in the critical accounting estimate, it generally is no harm to continue to stay in there, as opposed to pulling it out where somebody might then come back and say, why was that changed? Is there anything more to that story here? So it's enabling management to go back, challenge what's there, making sure it really does appropriately align to the SEC's guidance. And at the same time, I would say, not in terms of taking information away from investors, but could also reduce complexity and greater simplify in terms of some of the financial reporting and helping them connect the dots.
Great. A couple of questions about specific issues. So Megan, I'm going to turn to you about, can a significant deficiency in ICFR be a CAM, material weaknesses or a cybersecurity breach, and is a use of specialist in and of itself CAMable? Well, I think I just made up a word, but
Just don't come out with camping. Camtastic.
oh, I was going to say that in my
Sorry.
closing.
Oh, that's
Dang, I'll have to think of a
thunder.
new
I'm sorry.
way.
Well, you got a few minutes to
I
think
will.
about it. All right, so let me talk a little bit about control deficiencies. So, I think that the process to evaluate and conclude on the severity of a control deficiency, be it just a deficiency or a significant deficiency or even a material weakness, that process in and of itself doesn't necessarily directly relate to a financial statement, account, or disclosure. So that process is in and of itself not going to be the CAM. But I think the way in which you would think about the CAM would be the implication of that control deficiency on the audit. So I think it is probably going to be expected or likely in the case that you have a material weakness, you've already concluded that there is a control that didn't work, and now you have at least a reasonable possibility of a material misstatement. So it's likely to have a fairly significant impact on the audit, and it may lead to something that is pretty challenging, complex, or subjective. Excuse me. Similarly, on a significant deficiency, it's not as severe as a material weakness, but it could also nevertheless have a fairly significant impact on the audit. So as you think through that impact on the audit, you also are thinking about the accounts and disclosures that are actually impacted by the control deficiency. So it could be that the control deficiency is in one area, so taxes or pension or goodwill, or it could be something that actually relates to a combination of accounts and disclosures. Or it could be something that's pervasive, and it could actually affect most of the or all of the accounts or disclosures. I think that's then how you kind of get to thinking about, maybe you do have one or more CAMs, and that control deficiency could be among the principal considerations that would have led the auditor to determine that there is a CAM. So then you get to thinking about how you would then talk about it and describe the why of the CAM and how it was addressed in the audit. The release actually already points out, and it says that if the significant deficiency was one of the principal considerations, then typically the auditor might describe the control issues and the control work, or the work that the auditor had to do because there was that weakness in controls, but probably would not use the term significant deficiency because there wouldn't have been reporting by the company on that topic. However, if there was a material weakness, there would have already been a requirement for the company to include in its disclosures the existence of that material weakness. So therefore, there would be less sensitivity for the auditor to make reference to that material weakness description. So, so I think you'll see some different things potentially evolving in that space. And then to talk a little bit about, sorry, now I'm forgetting all the points of the question. I think it was cyber and then specialists.
Cyber specialists,
all
right, was the last one.
So cyber, so obviously that's a very challenging area as well. And I think, again, it's probably a little similar to the thought process on a control deficiency. I think you would think about the cybersecurity breach and what the impact was on the financial statements and the controls. So for example, if you had a cybersecurity breach that really was an attack on the company's general ledger, you would think about the impact then on the accounts and disclosures in the financial statements, and again, that cyber breach could then become one of the principal drivers or principal considerations for one or more CAMs. And again, when you think about how the company has had to deal with it and how it's actually impacted the company's financial reporting. So maybe they've actually had to accrue a loss for some contingency that has arisen, or maybe there are some additional disclosures that are being added, which then could become the subject of one or more CAMs. And then with respect to a use of a specialist, the use of the specialist in and of itself is probably not going to be the CAM, but again, it could be a driver for why, or a principal consideration as to why there was a CAM. So the fact that the auditor had to go outside of the engagement and outside of the engagement team and involve a specialist, which could be somebody in the firm or someone outside of the firm, is an indication that there is some level of complexity or challenging auditor judgment involved. So, I don't think all cases in which a specialist is involved is necessarily going to be a CAM, but in many cases it will. And actually, that is kind of embodied into one of the list of factors that an auditor might consider in terms of thinking about how which matters would become CAMs.
A number of questions about the number of CAMs that are anticipated. We talked a little bit about how there could be circumstances where there are no CAMs, but the expectation is that there would be at least one. But David, I don't know if you're prepared to talk about what you saw on average. I know the IAASB, there was an analysis done by Audit Analytics recently about the number of K-CAMs that they were seeing, and it was 3.2, I think, was the average. So any thoughts from the Dryruns that you've heard or think or want to share?
Yes.
Yeah, saw.
Yes.
Trying to give you a little bit of wiggle room to get out of that.
It's a really good question. I do think, building off of the PCAOB's guidance, talking about that there could be situations where there's 0 CAMs, but I forget the exact words, but it was along the lines of rare. Is that the right word? Or?
Yeah, I think just generally, it was generally expected that there would be at least one.
Yeah, so I think that's certainly our experience, Cindy, on this. I think I could envision maybe some limited circumstances. If you take maybe a very early stage biotech company, let's say, for example, that is just comprised of cash and R&D, maybe outside of the going concern, maybe that could be one, and probably some other types of limited circumstances that I suspect will have a similar fact pattern when they do begin to emerge. But between significant unusual transactions that occur, and companies doing a lot of transactions these days that may be one-off or bespoke, and that could even include business combinations, for example, coupled with regular recurring matters, I would generally expect to see a number of CAMs. That said, we do not have a specific target that we have used internally. We are applying the guidance, and it is what it is in terms of that. But again, we are challenging ourselves at the same time. If we're coming back with something that is very limited in terms of, let's say, no CAMs, maybe get an extra set of eyes on that to make sure that we're meeting both the requirements and the spirit.
Yeah, and David, I'll just jump in there and say, that sounds like a very, very rational approach, because I don't think the PCAOB is trying to artificially force CAMs where there are no CAMs. So clearly that's why the standard does provide for the ability for there to be no CAMs, and there could be any number of situations, I think, that might present themselves where quite rationally and appropriately the determination is made that there are no CAMs. So, and again, I don't think the PCAOB has any idea that they should see 2 or 3 or 4, and I think it's just, I think that people would like practice to evolve.
Todd, I was just going to ask, do you think investors are going to draw any conclusions about the difference in the number of CAMs from company to company? In other words, do you think they perceive that if a company that has, let's say, 12 critical accounting estimates has 3 CAMs, that maybe a robust audit wasn't done? I wonder if there's that opposite effect.
Yeah, in my experience, they'll probably compare with peers. So if 2 companies with similar risk profiles, similar size, one has 1, one has 5, let's being extreme here, that you would ask the question, why is there a difference? And then, my sense is it'll be logical. Maybe this company's done a lot of transactions, this one hasn't, right? But there will be those comparisons, so that's something to be mindful of. And I guess my question is, did you see any variability between sectors or industries? Because I think from a user of accounting information, there's pockets of complexity in certain sectors versus others.
Yeah, I think when we went back and took a look at sectors, this is one that we were very interested in as well. Again, I don't think it was unsurprising to us that there were more similarities when you start cutting across sectors than differences, just in terms of the basic issues that they're facing. But I will say, again, why we gave some limited number of examples and gave some writing guides, the descriptions of why a matter was a CAM and how it was addressed in the audit were really very different at the end of the day, not in terms of say in depth, but in terms of the content and getting more granular about the specific aspects that led to that, and not more generic. And we specifically didn't want teams, for example, coming up with a set of CAMs and then sharing that with others, because I think then that could just lead to I wouldn't say boilerplate, but consistency maybe where there otherwise shouldn't be.
Yeah, that I've heard from a number of audit committee members, two big questions, and I don't think we have the answers to those yet, but once a CAM, always a CAM.
Right.
So what I call the Hotel California, right? Once you put a CAM in there, is the expectation that it'll always be there? I think the simple answer is no, because it's meant to be particular or bespoke to that audit, but I think that's going to be hard to buck that notion that once you put it in there, it's hard to take it out. And then this notion about if there's, in a particular industry or segment, that this one has none and this one has three, what does that mean unless there are unique facts and circumstances? But I think that that's going to be part of the implementation process, that the PCAOB and the post-monitoring of the implementation will be looking at that kind of thing. But it does raise a question that I have for you, Wes, and that is, I'm guessing that the SEC is going to see, CorpFin is going to see a lot more auditor disclosures, CAMs, just because of the review of the filings than the PCAOB will, but in inspections.
Sure.
So can you talk a little bit about how I know you haven't implemented it yet because it hasn't happened yet,
Sure.
but what are your expectations around that?
There's a couple of things. From an internal perspective, you might expect, and I can confirm, that we're very closely coordinated between the Office of the Chief Accountant and the Division of Corporation Finance, as well as others within the agency. So that's the same coordination that exists with Megan and her team and others across the PCAOB. Coordination is important. The second is that I think it's important to understand that the objectives of a CorpFin review is different from the objectives, for example, of a PCAOB inspection review. That those are two different activities undertaken for different purposes. For a CorpFin review, the objective is to really review the filing in order to understand whether there's a material omission from the communication. That would be one example. Another example would be to review the communication to understand whether there's something that's misleading about the communication. Or even third, to review the communication to evaluate whether there's a material inconsistency. So those are the kinds of things that go into a CorpFin set of objectives in undertaking the review. But CorpFin has been reviewing disclosures and auditor reports, auditor communications for years, and I think we're very well equipped to undertake the additional communication that will be filed as part of CAMs.
So more to come on review of KCAMs and CCAMs, and you'll probably get questions about any challenges for audits of FPIs, foreign private issuers, but I suppose that more to come. We'll just have to have another webcast for that. One thing I'll note, because we're running out of time, but one thing I will note is that a lot of the questions that some of our viewers have, as well as some of those frequently asked questions that we didn't get to today, are actually addressed in the PCAOB's guidance that just recently came out. So I would direct our viewers to look at that too.
Can I just make one other point quickly,
Please.
Cindy, because I do think it ties into expectations gaps and also in terms of the number of CAMs. While there are a lot of similarities between KCAMs and CCAMs, there are some differences. And there are also differences within different jurisdictions. So when I think about the UK, for example, which was further ahead of the curve on this, having planning materiality used during the scope of the audit is a required disclosure, as well as how the auditors scope the audit and thinking about risks of material misstatement. Again, KCAMs, very focused on the matters of most significance during the audit. And we're dealing with something that is anchored to the financial statements and disclosures that are material. So it is a different grounding. And in fact, even the ISA observes there may be certain KCAMs that were communicated to the audit committee that may not relate to items that are included in the disclosure of the financial statements. What might that be? Something like an IT implementation issue as well. So I think it is something for us to also recognize that while the definitions may be similar, the outcomes may be a little different, and I think particularly given the advance that Europe has had with some of this, there may be a little bit more limited number of CAMs than what they've got, around the world.
So we are at the close. If you look at slide 16, we have put up the key takeaways that you all have had. I was going to go around robin and have you all give us your key takeaways, but so maybe like in 10 words or less, key
Sure.
takeaways.
Keep up the momentum. I think we've had a lot of progress, but we still have work to do.
Not a compliance exercise. Use this as an opportunity to deepen the conversation about audit quality and keep up the momentum that we have in terms of all of the members of the supply chain working together. And I know that was more than 10 words.
Might not be two. I would say that the requirements are principles based. So the nature of CAMs and the way in which they're going to be communicated is going to be driven by the facts and circumstances of each audit. And it's really important that that get remembered, because that's what's going to drive the provision of useful and informative information for investors.
I'd say communicate and educate, bring investor relations into the fold early. They're the first to pick up the phone from investors, so it's very important to bring them on board and educate.
He stole mine.
Okay.
3 words.
Okay. Well, in closing, I do want to thank all of you for your participation, Wes, David, Megan, Todd, and Leslie.